Hi everyone. Today it is my pleasure again to be with Kari Vatanen, Chief Investment Officer at Veritas Pension Insurance.
Hello, it's nice to be here with you, Florian.
Hi Kari, thank you very much. We are here to discuss a very interesting theme, investing past the pandemic, with again 3 different time horizons in mind: short-term, medium-term, and longer-term. This time, for this video, we'll be focused on the longer-term potential evolution of the investment world. The question I'd like us to raise and answer is the following: how do we see the investment world change once we put this pandemic behind us for good? We expect growth and inflation to shape the returns of 2021. We already had a discussion on this topic, you and I. Now, what happens when we pass the point of 2021 and we project ourselves in the future, in a distant future, I would say? And maybe I will start on this one. I think that from our discussion, what I'm gathering is that we would agree to some extent of seeing for the short and medium term a solid growth. We expect also inflation to be surprising the consensus to the upside. Now we expect this situation to also prevail in the future, and the reason for that is this double combination of governments ready to stimulate their economy a lot, and we've had a taste of that, I would say. And the second element is also a change in the rhetoric of many central banks. They've been fighting inflation, then they've been tolerating inflation, and now, for some of them, and especially the Fed, they are giving clear signs of encouraging some inflation above their target. We think that this combination of higher inflation, higher growth, leading to higher rates, could have a tremendous impact in terms of the overall investment world. And that is what you can see on the slide in front of you now with the 3 charts. The 3 charts, they draw a line between 2 different situations in the past. The average performance when growth, inflation, and long-term rates are below or above 3%. And this performance is clearly different from some of them, meaning especially for those that are currently showing signs of rotation at work. So what we think is that for the longer run, we could be surprised by the extent of the rotation we could see if we really enter this new era of stronger growth and stronger inflation. Kari, how do you see this situation now?
Let's say it's probable that we will see somewhat faster growth and inflation in the coming 12 months due to the huge stimulus packages. If I start with the graph on the left, it's probable that longer yields will rise and yield curves will steepen further, but I think that it will be limited in the longer run. I don't believe that Fed could rise their target rate over 2% in the next hiking cycle. Instead, we will see lower rates for longer time and always growing monetary stimulus. On the graph on the right, there's a picture on Japanification. I think that will continue and widen to other economies too. That would mean that secular stagnation will continue globally, and central banks will continue their massive quantitative easing programs. They will buy assets from the market until they have bought all them out from the markets.
Okay, so this time, I think it's time to say let's agree to disagree. I'm going to sum things up. We expect growth and inflation to be higher in the next 10 years than in the past 20 years, leading to a longer lasting rotation across notably equity factors. On your end, you expect to some extent the contrary, meaning still comparable growth, still comparable inflation, which should lead to the same patterns in terms of factor rotation overall. Well, that's a good summary of our exchanges, Kari.
Yes, that's good. And we need to check where we are after the next 5 years to find out.
True. Thanks, Kari, for being with us for these 3 videos, for being with us today, for your insights. Kiitos, Kari, and goodbye.
Thank you, Florian. Bye.